What index funds should you buy? Choosing the right index fund for your goals and risk tolerance can be a daunting task. You need to do some research and you need to read some books. I'll be giving you some recommended books at the end of this video. Here are some tips to help you make the best decision. Determine your risk tolerance. Before investing in any fund, it's essential to evaluate your risk tolerance. Are you comfortable with volatile swings in the stock market, or are you looking for a more conservative investment approach? A simple way to determine your risk tolerance is to use an online questionnaire or speak to a financial advisor. If you're in your 20s, you might be high risk because you've got time on your hands to ride the inevitable ups and downs of the market. Determine your investment goals. What are your investment goals? Have a think about it. Are you looking to fund your retirement, save for a deposit on a house, on a home, or grow your wealth over the long term? Understanding your investment goals will help determine the right fund for you. Consider the index composition. Index funds track a particular index, whether it's the S&P 500 or the Dow Jones Industrial Average, or in the UK it would be the FTSE 100. Before investing, look at the underlying index fund that the fund tracks and ensure that its composition aligns with your investment goals. Review the fund's costs. One of the main advantages of index funds is their lower fees compared to actively managed funds. However, some index funds charge higher fees than others, so it's essential to review the costs before investing. Evaluate the fund manager. While index funds are passively managed, there is still a fund manager overseeing the operation. Research the fund manager's experience and track record. It's important to ensure that they have a proven record of managing the fund successfully. Now I'm going to let you in on how I came to choose my index fund. It was pretty much down to the types of books I was reading at the start of 2019. I'd done my research and by mid-2019 I was ready to invest in the stock market. The research I put in gave me confidence to dip my toes back into the markets after a little 8-year break due to losing money on single stocks. I was confident I could achieve 8%, but I was also factoring in inflation, and my thinking was that inflation was at around 2% at the time. I would be earning a real interest of 6% per annum, still better than sticking it in a savings account in a high street bank account, which you get 1%. After putting the work in and doing the research, I wanted to go with a Vanguard Life Strategy Fund. Then it was deciding which of the 5 life strategy funds to go with. Each life strategy fund offers cost-efficient exposure to simple, diversified portfolios and is automatically rebalanced to maintain a specific asset allocation. At one end is the riskiest Life Strategy 100% equity, which is solely invested in shares. Life Strategy 20% equity is most cautious in terms of its allocation, with 20% shares and the rest in bonds. I compared the funds on Morningstar and eventually went with a Life Strategy 80-20, which is quite high risk. I'd done this because I intended and still intend to invest long term, like 20 or even 30 years. I was hoping to just leave my Life Strategy 80-20 fund and keep dollar cost averaging for the long term. This all changed when inflation increased significantly in 21 and 22, and I decided to change to a Life Strategy 100 fund, so that's 100% shares. I'd done this because I didn't want exposure to bonds during periods of high inflation. Inflation tends to be bad news for bonds because it eats into the future buying power of the fixed income they provide. So now you know how to pick index funds, and you also know how I decided on what index fund to invest into. With any investment, it is very important to do your own research. This is something I'm going to keep banging on about. Some of my friends and colleagues, family over the years have looked to chase quick, easy money without doing any research. This is exactly what I did before 2019. Don't do it. It just brings stress and anxiety. That is from my experience anyway. Your investments are your responsibility. Learn from my mistakes and get some financial literacy. Read a few books and this will give you some financial literacy. Start small and invest in the stock market if you're interested in higher returns than you get by simply leaving it in your high street bank. When you get more comfortable, you can gradually increase your investment. Before we finish, let's have a little recap of the main points. 1. Determine your risk tolerance. 2. Determine your investment goals. 3. Consider the index composition. 4. Review the fund's costs. 5. Evaluate the fund manager. Choosing the right index fund for your investment goals and risk tolerance is crucial to achieving success in the stock market. By evaluating your investment goals, risk tolerance, and considering the fund composition, costs, and management, you can make an informed decision that will help grow your wealth over time. Last thing I want to leave you with is some books that I recommend. These are the books that offered the most value to me when deciding what index fund to go with back in 2019. Rich Dad's Guide to Investing, Robert Kiyosaki. The Little Book of Common Sense Investing, John Bogle. This book is what pushed me towards Vanguard funds, by the way. Unshakable, Your Guide to Financial Freedom, Tony Robbins. Money Master the Game, 7 Simple Steps to Financial Freedom, Tony Robbins. The Intelligent Investor, Benjamin Graham. How to Own the World, Andrew Craig. That's it for today's video. You are now armed with some info so you can get your head into picking a suitable index fund. Now you have to do some further reading so you fully understand index funds, what the best fund is for you, again based on your risk tolerance and your goals. Anyway, that'll do. I'll see you on the next one.